Recipes for technical trading success in Cook's Kitchen.
Are you ready to simplify your life with the 3 most basic rules of a bull market? I'm going to give them to you in one slide, simple as pie. First, we got to do a little homework. All right, last August, I coined a phrase, the $200 Club. Actually, I coined it before then, but I made a video on August 10th called the $200 Club, and it featured 5 stocks that I thought were in a race to $200. They were all trading like 150, 160. They were Alibaba, Facebook, Align Technology, NVIDIA, and Lam Research. If you don't know Align Technology, they make the clear dental straighteners Invisalign, and Lam Research, LRCX, is a semiconductor equipment maker. They make the wafer fabrication equipment that a Micron or an Intel would buy to make their chips. All right, so that video is always good to watch to get a flavor for why I was so confident that all 5 of these stocks would go to $200. The only one that hasn't made it yet is Facebook. Facebook is struggling with its own problems. Meanwhile, Align has gone to 300. In fact, I think earlier this year I said, once NVIDIA and Align had moved solidly above 200, we're trading like 250, I said, now we have a race to 300. Align won that race, and I just actually took profits. We booked like 150% gain above 330 on Align Technology. NVIDIA still holding strong. BABA just made new highs this week above 208, I think. Lam is struggling, but I have faith it's going to get there. And Facebook has its own problems, but I bought the dip at 155, and we'll come back to that theme. All right. Then in January, Tracy Reinick invited me as a guest on her podcast, the Market Edge podcast, a phenomenally successful podcast here for Zacks. And the theme was, is the stock market melting up? Because we were making tremendous new highs, so we looked at stocks like Netflix, Square, Boeing, which was on a tear. Boeing had a higher PE than Facebook, Pioneer Resources, and NVIDIA. And what I gave Tracy during this discussion was my melt-up recipe. And, so we're basically looking at some stocks getting overvalued. And for sure, the Dow had gone vertical. In fact, a week before, I had warned Zacks Ultimate members, hey, this Dow is way overbought. And sentiment was crazy, too. The Investors Intelligence Sentiment Survey was 4-to-1 bulls to bears, which was like over that, and it was like we hadn't seen a peak in optimism like that, exuberance actually, since 1987. So I said, hey, this market's due for a pause, and that's what we got in late January into February, and it's been a long, slow correction, but I've been saying buy the dips in your favorite stocks. All right, so here was my melt-up recipe. 3 basic things for the multiple expansion, meaning PEs could keep expanding because the process was under control. It wasn't like the rallies of 1999, 2000, where the NASDAQ was trading at 50 times or more. Stocks like Microsoft, Amazon, Google, Facebook, Apple, those leaders, plus tons of others had decent valuations. So more upside to go. Number 2, competition. Less stock and more investors. And let me explain this a little bit. This is about the institutional money that goes into stocks. In fact, it has to go into stocks. It's taken from savers, given to money managers, and it is earmarked for one thing, and that is buying stocks. They have a charter that says, this is what I will do with your money. So, and I have 2 simple rules that go back to 2009. I wrote at the start of the bull market, I said, the number 1 rule is they have to buy. And the number 2 rule is they don't have to sell. Meaning that big fund managers, if they like a stock, they can handle a 25% drawdown, even a 50% drawdown. Maybe they'll buy more. They don't have to sell. So when you know that's how institutional money works in the stock market, you need to use those rules in your favor. And we'll come back to that theme in a moment. All right, number 3 of my melt-up recipe back in January was we had no global macro worries. I said, whatever happened to the Eurozone crisis or China having a hard landing, For the first time in a decade, the global economy is in sync and growing at the same time with virtually no economic crisis looming. And I would throw in the earnings recession was over, 2015, 2016. We survived that. How many large investors got fooled by the earnings recession of 2015 and 2016? I know I finally did, was selling when I shouldn't have been, because I thought that the earnings recession, 6 quarters of negative growth, would lead to an economic recession, and it did not, okay? And, then all the concern about rates rising, interest rates rising. It's another fear that has, been pumped up ad nauseum for the last 8 years because of quantitative easing and the Fed's $4 trillion balance sheet. Nonsense, not a factor. Rates are still incredibly low, and they're going up slowly. And anything from Washington, D.C. was also, so I got China, Europe, politics in D.C., the earnings recession and rates. None of those global macro worries mattered, all right? So, and they still don't. Well, maybe we got a trade war, maybe, right? All right, on March 5th, March 15th, I'm going over all this little bit of history here of what I've done with this because I want you to see the persistent themes, because the persistent themes will explain my 3 simple rules in one slide. That's coming up at the end here. All right, I wrote a wonder to behold, last innings of the bull market. I featured stocks like YY, Shopify, Salesforce, Amazon, and Adobe. And I actually made a list of software stocks, that I either let go of too soon or didn't buy. And because I'd been focused a lot on the hard technology like semiconductors, but there was software that I knew made sense too. Both Salesforce and Adobe, I sold them too soon as the market just kept going sideways, especially during the correction. And boy, they're up. Each of them are up over 50% from where I sold them. And these were, my fundamental reason for owning them was that these are killer franchises, right? Salesforce and Adobe do unique things in software, and they are embedded in the Fortune 500. Once the Fortune 500 becomes a customer of Salesforce or Adobe, they never look over their shoulder. I thought of the infamous Twitter meme for that. They just don't, because those platforms provide everything they need in terms of either CRM management or Adobe allows corporations to do their own marketing, advertising, documents, all that stuff. Okay. Amazon, I knew I should have bought Amazon under $1,000 a couple of quarters ago. Instead, what I did is last November, I recommended investors buy the June 1,200 call for $70. Have you ever paid $70 for one option contract? Well, you do it with Amazon, right? Those calls, those June calls, which are expiring in a week or two here, are trading nearly $500. So you could have made 7 times your money on Amazon just by buying the June 70 call, the June 1,200 call rather, for $70. Now, and you have plenty of chances in November and December when I recommended that, and I repeated it many times. There were plenty of chances to buy that June 1,200 call under $100 and make at least 5 times your money. All right, moving on here. Oh, here was my list of software stocks that I wrote from Adobe to Zen. 21 stocks we let go of too soon or failed to grab when they were in our sites. Talked about Amazon. I got CyberArk and FireEye in here. FireEye, we made some money on FireEye, but I got spooked out of it. RealPage, we made some money on one time. They make software for managing real estate businesses, empire, so to speak. Shopify, geez, every time I looked at it, it would seem too expensive, and it just keeps going higher. It's it's like a Facebook story in terms of, or Amazon in terms of a platform for buying and selling. Twilio and Zendesk, I looked at both of those at under $30, ignored them. They've just about doubled, I think. YY's been a trickier one to trade, but you can find this article on Zacks.com, March 15th. All right, and at the time I wrote, what's the moral of the bull story? Got a minute? Watch this video. I recorded a video. On Fridays, I used to do a weekly segment with Angela Miles over at the CBOE, Chicago Board Options Exchange, CBOE TV. And she asked me, what's your what's your number one tip for investors? Give me a trader's tip. Well, I went big picture. And in 1 minute, I summed up my thesis of what you do in a bull market, and that's where you follow the smart money managers. What are they doing? They're putting money to work for 2, 3, 4, 5 years. They're not buying and trying to swing trade quarter after quarter. They're picking companies they like, trying to get the stock at a valuation they think is reasonable, and then looking out long term. What is the development of this franchise? That's why Adobe, goes to 250 bucks. That's why Salesforce will go to 150. Amazon is going to go to 2,000 before this bull market's over. Apple is going to hit 200 probably any day. And Facebook, Alibaba. Alibaba's coming up. All right. So I'll link this video, the 1 minute video. I'll link it in the article that goes along with this video. So if you're on YouTube, come on over to Zacks and you'll find all the links too. All right. Whoa, look at this. Technical analysis doesn't work? Well, by itself. Let me explain. Let me give you some backstory. So this is what I wrote to my Taser subscribers earlier this week, I believe on Monday, when I had an Elliott Waver, a globally respected Elliott Wave chartist, who showed they were trying to buy Alibaba on a dip, and 164 was their place to entry, and shucks, they missed it. And that's my prime example of why technical analysis doesn't work by itself. You need to know the fundamentals too. We've been buying Alibaba since 100 bucks over a year ago in 2017 when we got the chance. And why? Because we know the fundamental story. Really, they are the Amazon of China, not just to Chinese consumers, but also in terms of their growth. They're even growing in the cloud. And they are a technology company and a retail company. It's really hard to pigeonhole them, but what they're doing in China is equivalent to what Amazon has done in the US and globally. So that's the fundamental story with Amazon, or with Alibaba, and that's why you got to know the story. That's one of our rules coming up. Okay, so I show this chart. How much can you limit yourself if you only use charts and neglect to have a fundamental view? So here's my great example. This is from Elliott Wave Forecast. So here was their post on June 4th. They said, back in April, it missed our long entry at 164 and then rallied to make new all-time highs. Okay, so, and there's their whole Elliott Wave chart. So it missed their long entry, meaning they have a precise method. And you should with buying stocks, whether it's fundamental or purely technical. But the stock missed their entry, so they wouldn't buy or didn't buy. Now maybe they did buy. Maybe some of them did. But anybody who listened strictly to wait for it to get to 164 didn't buy Alibaba in April and has lived to regret it since the stock's trading 208 now. So here's how I sum it up. They basically swung and missed by only looking at what the charts told them. They pinched pennies at 164 when gifts from the gods were trading at 166. I just elaborate here for my subscribers that, I always encourage them to stay long and strong, buy under 170 if you can before earnings, and that was your last chance. I mean, the stock probably isn't going below 200 for a while. A little component here, I half in jest say that my conviction was not purely fundamental, only 88%. The other 12% was half technical, half behavioral. And the behavioral aspect of my approach to the markets is knowing what the big boys and girls are doing with their money, as Alibaba represented their second chance to own Amazon. That was the theme I just talked about. Even if you don't believe that Alibaba is another Amazon story, what do large investors believe that are putting money into it? That's what you want to know. Oh, and finally, I'll link to this too. For the Zacks Ultimate Strategy session in early May, which is just for our Zacks Ultimate subscribers, but you can find it on YouTube now if I give you the link. Alibaba was my top pick, and I do a little focus on their grocery business and how that's going to kill it for them and what it's going to do to their revenues. When analysts are looking at, oh, Alibaba might grow 40% revenues, they keep coming out and saying, you know what, we're going to grow at 60%. Okay, so I'll link to that in the article that goes with this video. Okay, so let's do it. let's do the 3 rules of a bull market. Number 1, buy and hold. You know, after the Great Recession and, bear market collapse of 2009, I started a theme called buy and trade. Well, buy and trade was clever, but what have we learned about this bull market? Buy and hold still works best in Amazon, in Adobe, in Salesforce, in Alibaba, in Lam Research, in Align Technology. Need I go on? The number 2 rule of a bull market, buy what you know. Now, this sounds like throwback to Peter Lynch, buy companies you know. I like that idea. You know, if you know a business, a product you buy, you like the product, you see other people buying the product, that whole thing. But I expand the buy what you know into buy what you're willing to do homework on to know, okay? You still have to do your homework. Like for me in Align Technology, I listened to all the conference calls, I read all the research reports, and I understood how they were capturing market share. They were capturing orthodontists, dentists, dental professionals, getting their attention, getting consumer attention, growing that business. We talked about Alibaba. The chips. Chips are harder to understand. Software might be even harder to understand, but you have to know who the customers are, what they're spending, why they're buying that product, whether it's a retail product or a Fortune 500 product. Okay, so that's my buy what you know, expanded on from Peter Lynch. And finally, buy the dips, right? I mean, that's why I told my people to buy the dips in Alibaba below 170, and we're glad we did. All right, I think that's it. So those are your 3 rules of the bull market that will apply to any bull market. So if you are a young investor, you're going to get another chance. I'm not saying this bull market's over. Please continue to follow those 3 rules. It's just that we might be in the 6th or 7th inning of this bull market, okay? We haven't seen the top, but I said last month, S&P is going to 3,000, probably higher. If you are a mature or older investor, have your kids and grandkids watch this video. Have them learn, because if they don't have major money to put in stocks yet, they will someday. And this knowledge will stand the test of time, and it will apply to a bull market in 2040, 2050, 2060. So this stuff will apply and will make you money over the course of a lifetime, could create wealth for your family. All right, thanks for joining me in the kitchen.